Welcome to The Explainer. Today we're diving straight into the hidden plumbing and the unseen economics of your daily digital finance. You know, every single time you tap your plastic, this massive, totally invisible machine springs into action. So we're going to tear down the walls of that machine to see exactly how it works, and maybe more importantly, who's actually paying for it.
1.5 seconds, that is it. This incredibly brief window is literally all it takes for your payment terminal to either approve or decline a transaction right after you tap your card. I mean, to us it feels instantaneous, right? Just a quick beep and we're on our way.
But what is really happening in those 1.5 seconds? It's not just some simple routing exercise where a computer lazily asks your bank, hey, do they have enough money? No way. It's this extraordinary flurry of data processing, deep risk assessment, and global communication, all happening in the literal blink of an eye. To really understand this, here's our game plan. First, the fraud prevention window. Second, chargebacks and your safety net. Third, we'll trace a literal 10,000 rupee swipe. Fourth, we'll see where the MDR goes. And finally, number 5, mastering your credit card. Let's get into it. Section 1, the fraud prevention window, the 1.5-second magic. Let's look at how this builds from the exact second you tap that card at the terminal.
So within just 200 to 500 milliseconds, which is basically nothing, your issuing bank's fraud detection engine runs an insane number of checks. It looks at velocity. Did you just buy something in Bengaluru at 8 p.m. and then magically try to swipe in Mumbai at 8:03? It checks behavioral baselines too. Like, is an HDFC Infinia card holder who usually books the Taj suddenly testing a sketchy $4.99 transaction at an unknown Tier 3 Kirana store? It instantly cross-references geography, device fingerprints, and merchant histories. If anything looks even slightly impossible or statistically weird, the system just catches it and shuts it down.
Now, you might be wondering why banks go to such extreme, high-tech lengths in half a second. Well, it's because the issuing bank bears the absolute full cost of fraud. If they approve a bad transaction, they take the financial hit. Period. To cover this, they maintain what's called a fraud loss reserve. And as we're going to see in a minute, this reserve, and honestly, the whole risk management system, is entirely funded by the transaction fees that merchants pay. Section 2. Chargebacks. Your safety net. Slowing down the transaction. So we've seen the microseconds of approval. Now let's look at the long-term safety net that's built into the system for you. Picture this. You book an 18,000 rupees hotel in Goa through some third-party site. You show up, bags in hand, and the hotel is like, we have no record of you. Nightmare, right? Now, if you paid by UPI, your recourse is pretty limited. The dispute mechanism is slow, kind of undefined, and frustrating. But if you paid by credit card, you are protected by Visa, MasterCard, or RuPay rules. You can force a chargeback, and boom, your 18,000 rupees is typically returned to your credit limit within just 7 to 10 business days. This dispute process is super structured. You report it to your issuer, the network pings the merchant's bank, and the merchant actually has to prove the transaction was legit. This whole dance takes about 60 to 120 days. And if the merchant loses, not only do they lose the original transaction amount, but they get slapped with a penalty of anywhere from $1,000 to $2,500. And again, this incredible consumer protection, funded entirely by merchant fees. Section 3. Tracing a 10,000 rupee swipe. Following the money. Okay, let's dive into the core economics by tracing exactly what happens when you make a typical purchase.
Let's say you walk into Chroma and drop 10,000 rupees on a new gadget using an HDFC Regalia Gold card. At the exact moment of the swipe, no actual money moves. It's just an authorization token. The next business day, Chroma batches all its transactions, Visa calculates the net amounts, and HDFC transfers the funds. But here's the kicker. Chroma does not get 10,000 rupees. Nope. Chroma receives 9,820 rupees. That missing 180 rupees, that is the 1.8% merchant discount rate, or MDR.
So, where on earth does that missing 180 rupees go? It's sliced up amongst the key players. The lion's share, about 140 rupees, goes straight back to HDFC, since they are the issuer taking the credit risk. A 25 rupee slice goes to Visa because they're the network routing all that complex data. And a tiny 15 rupee sliver goes to Axis Bank, which, in this example, is the acquiring bank that provided Chroma with the actual physical payment terminal.
Section 4. Where the MDR goes. Deep dive into the issuer's cut. Let's zoom in even further on that massive 140 rupee slice that went back to HDFC. Because spoiler alert, This is exactly where your rewards come from.
Out of that 140 rupees, HDFC hands you back about 67 reward points. That's literally the only part of this entire system that you, the consumer, actually see. But the rest of it, that funds the bank. They use $5 for operations and customer service, $8 goes straight into that vital fraud protection reserve we talked about earlier, and finally, $60 goes to HDFC's profit margin for spotting you a 45-day interest-free loan. It's a highly calibrated machine.
Section 5. Mastering your credit card. Playing the game. Now let's talk about how these invisible economics absolutely dictate the practical everyday rules of choosing and using your credit card. Rule number 1. Category rewards are structural. So when an SBI cashback card offers you a whopping 5% back online, but only 1% offline, that's not just a temporary marketing gimmick. It perfectly reflects the reality that online transactions structurally charge a higher MDR to the merchant than offline ones do. Simply put, the bank has more fee revenue to share with you when you buy online.
Rule 2. Government payment reward exclusions are permanent. You see people complaining online all the time when their premium cards suddenly stop giving points for income tax payments. But here's the deal. The government legally mandates a 0% MDR on these payments. There is literally no fee to share. HDFC or SBI can't give you points on money they aren't making. So, pro tip, always use a lifetime free card for government categories.
Rule 3 perfectly explains those crazy high reward rates you sometimes see. Massive rewards, like getting 10% back on Swiggy or 25% on Airtel, exist because the partner brand is actively subsidizing rewards way above the normal MDR ceiling. Swiggy is literally paying out of their own marketing budget to keep your loyalty locked in. You should absolutely use these structural wins for your highest spend categories.
Rule 4. Fuel is a permanent low reward category. Fuel stations have a legally capped, very low MDR. So please, do not waste your premium HDFC Infinia card at a petrol pump expecting massive points. The bank simply isn't making enough on that transaction to reward you. Instead, you've got to use a specific co-branded fuel card, like a BPCL or HPCL card, where the oil company itself is subsidizing the rewards.
Rule 5. Visa and MasterCard will structurally out-reward RuPay. Honestly, unless your only goal is 0 annual fees and linking to domestic UPI, Visa and MasterCard variants are almost always going to offer better rewards for high-spending users. Why? Because their interchange economics simply support a higher reward structure than RuPay currently does for standard domestic spending.
Okay, so applying all of this, here is your everyday risk-matching rule of thumb. Use UPI for daily, low-value transactions under 5,000 rupees with known merchants, your local coffee shop, your regular auto driver. But always use a credit card for high-value purchases, travel bookings, or unknown online merchants. You want to guarantee you have that ironclad chargeback protection in your back pocket.
When you sit back and look at those points racking up in your account, just remember one thing. This is not free money. Not even close. It is a rebate. Your rewards, your fraud protection, your 45-day interest-free grace period, all of it is funded by the fees that merchants pay just to accept your card. It's a closed-loop system perfectly designed to incentivize your continued spending.
So think about that hidden 1.8% tax on the system the next time you tap your card. You are participating in this massive, instant global economic trade every single time you buy something. Knowing exactly who funds your points, who pays for your fraud protection, and how the banks actually make their margins, how will you choose to optimize your wallet and swipe tomorrow? Thanks so much for joining me on this explainer. I really hope it completely changes how you look at that little piece of plastic in your pocket.